If you're like me, you probably want to have money in your bank account versus giving it to the tax man. This requires a simple knowledge of the tax deductions here in Hong Kong, which is actually easier than you think. Hey friends, welcome back to the channel. In this video, we're going to go over two types of insurance products you can purchase to allow for these tax deductions. We're going to have a look at the limits of the taxable income for each of these types, including how I save $12,000 a year. Lastly, we're going to have a look at the eligibility requirements. Let's get started. So for specific tax advice, talk to your accountant. This video is a general overview of the two types of products and their tax deductions here in Hong Kong. Those two types of products are VHIS and QDAP. So VHIS stands for Voluntary Health Insurance Scheme. And basically it's just a medical plan. It's an insurance product that is a medical plan. And these plans were created initially by the Food and Health Bureau of Hong Kong, basically to alleviate the public system and the strain on public hospitals, to offer private medical at a competitive rate to the mass public. And so if we have a look at the website, basically it defines what a VHIS policy is, has a bit of eligibility, which we'll go over in a minute. But basically here there's a list of certified plans. And so everything is regulated here. And if you have a look at this website, basically it'll say, all right, all these plans under here are listed and certified. So each has a unique identifier that we can claim tax deductions from. Okay, so that's basically a VHIS plan. And if we have a look at a QDAP, which is a Qualified Deferred Annuity Plan, basically it's just an annuity plan. And an annuity plan is something that we save up now, and then we have basically a regular payment from the policy later at a later date or immediately. In this case, we're talking about not immediate, but deferred annuities. So a typical example would be you would contribute for 5 years or 10 years in your working life, wait or defer it until retirement age, 55 or 65, and then take annuities from that policy, which would pay to you for, let's say, 10 years or 20 years. So that's what we call a deferred annuity. It's put off. And if we go to the government website again, once again, it defines it and it has a list of QDAP eligible for tax deduction. So if we have a look at that, basically it points us to the Insurance Authority webpage where there's a list of many different insurers and their product names. If we have a look at the Excel, which is basically a condensed list, it's easier to see. Basically you can see sort of 2 pages of all the names of insurers and the Qualified Deferred Annuity policy, its name. And so that's basically showing all the policies that are eligible if you've purchased them for tax deductions. So how much can we actually save? So if we look at the guidelines for salaries tax for personal assessment, this has only been going on for 2 years, 2019 to 2020 and 2020 to 2021. So for VHIS, that amount is $8,000 per year. For QDAP and voluntary MPF contributions as an aggregate, that is $60,000 a year. So for VHIS, ideally $8,000 at a rate of 17%, which is the maximum tax rate after all your deductions and all the levels, is basically $1,360 a year. Now currently for my family of 4, we're all under $8,000 a policy. So for myself, I pay $4,744 for my age for a VHIS medical plan. At 17%, that's $806. For my wife, that's $4,410, which at 17% is $749. And for our 2 children, they are at $2,425 for their plans, which is at 17%, $412 each. This brings a total savings of $2,379 for all 4 of our medical policies each year. So you can argue that one of them are free almost, but medical costs increase, and the maximum is $8,000. So once we reach $8,000, which might be age 75 or age 80, which we probably wouldn't be paying taxes anymore anyway, basically that's when it wears off. Okay, so for QDAP, I don't actually do the MPF voluntary contributions simply because I think there's better investments out there. So I maximize on the QDAP, which for this category is $60,000. And $60,000 at 17% is $10,200 or $850 a month. So the total savings for myself is going to be $10,200 plus $2,300 or $12,000 this year. Now that'll go up slowly each year. So all you need to do is actually fill out what you put in what you have actually paid that year into the deductions column in the form, and then specify your relatives as well with additional VHIS if you have more than one family member. And that's it. So who's actually eligible to claim these tax deductions? Well, for the year of assessment, the insured person has to either be yourself or a specified relative. So they need to have a Hong Kong ID card, as well as for children's policies who are under the age of 11, they might not have a Hong Kong ID card, but the parent can claim their benefit. For the specified relative who is the insured, this might be in the case where, for example, I'm purchasing for my wife or for my specified relative. So I'm the policy owner, but the insured is my wife or that specified relative. So these people can be my spouse, a parent or a grandparent of you or your spouse, who might be age 55 or more, or if under age 55, can also claim under the disability allowance scheme. So basically, if they're disabled under age 55, you can purchase one of these plans for them and claim the deduction. A child or sibling of you or your spouse who is unmarried, or if under the age of 18, or from 18 to 25, a full-time education at university or similar. Basically, if they are age 18 or more, but incapacitated to work, you can also claim their policy if you purchase one for them for tax deductions. So the limit is $8,000 per person, per insured person. And there's no limit on the number of specified relatives. So in conclusion, if you're thinking about purchasing a medical plan anyway, why not consider these VHIS medical plans, which are government certified and government backed? And in fact, I like these so much that I actually created a separate video for them, which I'll put links to at the end of this video. The tax savings are pretty good. As well, if you have money lying around or thinking of an additional savings plan, a qualified deferred annuity product also is a wise choice. It's generating about 3% IRR, but it's arguable that with the tax savings, you get another 1 to 2% on that. So more money in your pocket versus giving that in tax money to the government. That's it. Once again, if you found this video useful, kindly give me a like and a subscribe. It would really help the channel, and I hope to see you in the next one. Thank you.